Hi guys, it's Annika here with TipRanks, and today we're looking at 3 big dividend stocks yielding at least 7% that Raymond James analysts deem a buy. The first on the list is Starwood Property Trust, and its ticker is STWD. It's a real estate investment trust, a REIT, and as we know, real estate investment trusts have earned their status as top dividend earning stocks. The company focuses mainly on commercial mortgages, although its $17 billion portfolio covers a wide range of commercial, residential, and infrastructure loans and investments. Starwood is one of the country's largest commercial mortgage special services. The current share price for Starwood Property is $24.89, and the analyst price target for STWD is $28.50, which is a 14.55% upside, and this is based on 4 Wall Street analysts offering 12-month price targets. Raymond James has given a price target of $30, which is a 20.29% upside. But looking at the dividends, the next ex-dividend date is September 29, 2021, and the payment date is October 15, 2021. The following ex-dividend date should be expected in December 2021. The dividend amount per share is 48 cents, and the dividend yield is 7.68%. The payout ratio is a whopping 115.70%, and the dividend growth has been substantial across the last 8 years. And the analyst consensus is also that it is a strong buy. Starwood has seen its share price rise in the last 12 months, and it's increased in share price by a whopping 79%. The most recent quarter for Q2 2021 saw Starwood post revenues of $290 million and an EPS of 40 cents. These figures lagged the analyst estimates, although the top line was up 9.8% from the year ago quarter. The distributable earnings were $153.2 million. On the dividend, Starwood declared in June its Q2 payout of 48 cents per common share. The company has held the dividend at this level consistently since 2014 and has had a reliable payment history going back to 2010. The dividend annualizes to $1.92 per common share. This compares favorably to the average dividend of 2% found on the general market. 5-star analyst Stephen Laws, writing for Raymond James, noted that Starwood occupies a strong position at its niche. He says of the company that we believe that Starwood's diversified business, scale, and strong balance sheet warrant shares trading at a material premium to most peers. Starwood continues to experience strong interest and rent collections in the second quarter, with commercial lending, the property segment, and infrastructure lending segment all receiving at or close to 100% of payments. Overall, Starwood gets a unanimous analyst consensus as a strong buy. The second dividend stock is Plains All American Pipeline, and its ticker is PAA. Plains All American is a midstream energy company, and it holds a vital position in the fossil fuels industry, moving oil, gas, and their refined products. From wellheads to refineries and storage facilities to transport hubs, and finally distributors and customers, Plains All American is based in Houston, Texas, and moves more than 5 million barrels of crude oil and natural gas liquids daily through its asset network. The network includes oil and gas pipelines stretching from the Canadian Rockies to the Gulf Coast, and storage facilities in California, the Great Lakes, and the Chesapeake. The current price for Plains All American Pipeline is $10.52, and the analyst price target is $12.63, and this is a 20% upside, and this is based on 4 Wall Street analysts offering 12-month price targets. The next ex-dividend date is October 28, 2021, and the payment date is November 12, 2021, and the dividend amount per share is 18 cents, which brings it to a dividend yield of just shy of 7%, and the payout ratio is a whopping 447.2%. The last dividend growth was seen a year ago, and the analyst consensus is a hold. Midstream valuations have decreased relative to other asset classes, although balance sheets, overall financial health, and cash flows and governance have improved. So multiple large cap entities have shown a strong current dividend to distribution yield and high coverage. Plains All American has seen its revenues recover steadily from the COVID trough of Q2 2020 around this point here. Once global demand recovery increased, we saw that the most recent Q2 2021 showed a $9.9 billion at the top line, more than triple the figure from the year-ago quarter. EPS came in at a loss of 37 cents per share, the first net loss since Q1 2020. The company reported strong cash flows and forecasts of $1.35 billion in total free cash flow for Q2 2021. And this is very important as the cash flow covers the dividend payments. Plains All American was forced to slash the dividend payment early last year from 36 cents to 18 cents per common share, but it has held the payment steady at that level ever since. In July, the company announced its most recent distribution, which was paid out in August. At the current rate, the dividend annualizes to 72 cents per common share. The third dividend stock is another energy midstream giant, and it's called Phillips 66 Partners, and its ticker is PSXP. The current price of Phillips 66 Partners is $38.70, and the analyst price target is $39.83, which is a 2.92% upside, based on 6 Wall Street analyst ratings offering 12-month price targets. The last ex-dividend date was July 29, 2021, and the payment date was August 13, 2021. The next one should be around October 2021. And the dividend amount per share was distributed at 0.88 cents. And this gives us a dividend yield of 9.1% with a payout ratio of 171.74%. And they have had dividend growth since the last 8 years. And the analyst consensus is that it is a strong buy. Phillips 66 Partners operates mainly in Texas, Louisiana, and Oklahoma, but the company's network extends into and up the Mississippi Valley and the Rocky Mountain region. The company also has refining facilities on the West Coast and in New Jersey. Phillips 66 Partners operations currently consist of crude oil, refined petroleum product, and NGL transportation, terminaling, fractionation, processing, and storage assets that are geographically dispersed throughout the United States. Phillips 66 Partners shares were up 55% in the last 12 months, reflecting increased demand and increased traffic in the fossil fuel products. Increased business can see an increase in earnings. The partnership company reported net earnings of $225 million in the Q2 2021, compared to the net loss of $18 million in the year-ago quarter. The company also reported continued progress on the C2G pipeline, a project connecting a major storage facility to a petrochemical factory in Texas. The 16-inch pipeline will carry ethane products and is scheduled to open in Q4 2021. Turning back to the dividend annualizes to $3.50 per common share. And once again, turning to the analyst Justin Jenkins, who writes for Raymond James, says that as the market normalizes, which Q2 2021 results begin to indicate, the interplay between the Phillips franchise should be a more tangible uplift for Phillips 66 Partners. Over time, we can envision growth optionality via drop-downs, expansions, bolt-ons, or M&A. Meanwhile, MVC support for Phillips 66 remains a solid backstop, adding confidence in Phillips 66 Partners' financial flexibility. We remain positive on the medium and long-term outlook and believe that Phillips 66 Partners' near 10% distribution yield approximately compensates investors for the risks. So guys, those are the top 3 big dividend stocks that are yielding at least 7% that Raymond James analysts deem a strong buy. What do you guys think of these stocks? If you have any thoughts, leave them in the comments below. And if you made it this far, don't forget to hit that like button down below and that subscribe button and that bell notification so that you can get informed on when the TipRanks channel releases videos. I'll see you guys in the next video. Bye!